Hey, Jason here. Today's video we're going to analyze, or I'm going to answer the question, is health company Medifast, stock ticker MED, a buy? This is stock analysis for Ocean, who requested this on YouTube. Before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Okay, before we get to that though, I apologize for this. I don't want to do this. If you see my other videos, I don't want to do this, but I have to do this because every time I don't, I get nasty comments. This video or audio is for your informational purposes only to help, and it's also to help you figure out how to find or to evaluate stocks better and faster so you can potentially find better investments and earn higher investment returns. These are also done at the request of viewers. Because of that, I often don't know what the companies do, and I purposely keep it that way. And the reason I purposely keep it that way is so that I'm not biased either positively or negatively by what the company does. This also means I don't care about what the company does, what they say they're going to do, what the CEO says they're going to do what the industry is happening. I don't care at this stage. That's far later in the analysis. At this point, for me, and again, I purposely keep it that way. I also do not short sell ever, so I don't benefit from any stock I talk negatively about. I also don't own any stock in a long position, any stock I talk positively about. Again, this is done to help you figure out how to find or how to evaluate stocks better and faster only. At this point, again, for your informational purposes only. Why should you listen to anything I have to say? In the first 9 years of my career, I produced average annual investment returns in the portfolios I manage of 23.5% per year on average. That puts me just behind the great Warren Buffett, who produced 24.2% average annual investment returns in the first 9 years of his career at the Buffett Limited Partnership. My numbers legitimately make me one of the best stock pickers in the entire world over the last 9 years, and I've almost tripled the market in the last 9 years as well. Again, I'm not saying any of that to brag. Frankly, I don't like saying it. But the only reason I am saying it is to prove to you that I actually know what I'm talking about a little bit. Okay. So, again, apologize for that. Don't want to do that. Don't like doing that. But we're going to get to Medifast. Okay, brief pause there just to open the tabs because I forgot I hadn't opened the tabs yet. They pay a decent dividend, which is actually a little bit surprising. They're $2.2 billion market cap. Most small-ish companies don't pay even decent dividends, but they pay a pretty good one. So that's interesting. They are at kind of the lower third of the range for the year, which is interesting. This is not great. I don't care about forward PE ever, but this being not showing here is a sign or shows that the company is unprofitable. So that's not good. Here's what Medifast does. I do not know what this company does. I've never heard of this company. Again, this was requested by Ocean. Thanks as always, Ocean, for requesting these videos. Love doing these case studies for you. Medifast Inc. is a U.S.-based company that produces, distributes, and sells products concerning weight loss, weight management, and healthy living. The company generates its revenue from point-of-sale transactions executed over an e-commerce platform for weight loss, weight management, and other consumable health and nutritional products. Okay, interesting. So they're a health company. They sell things like supplements and weight loss products. That is pretty much always in fashion because people are always trying to lose weight. So that is a good thing. There's also some kind of negative things, or there could be negative things. Here, the U.S. government in particular has cracked down on what you can and can't say when you're promoting these kinds of products. And that's led, I don't know about Facebook or Google, but I know Facebook has cracked down on what you can and can't say in selling weight loss products on their platform as well when you're running ads. Okay, their revenue has skyrocketed from $298 million in 2011 to $1.3 billion in trailing 12-month period. That's fantastic growth. With that, their operating profits have gone up, and their operating profit margin has gone up, which is a little bit surprising, but both are very good. Operating income has jumped from 27 million in 2011 to 197 million in the trailing 12-month period. Again, fantastic growth. Operating profit margin has gone up from 9.2% in 2011 to 15.5% in the trailing 12-month period. So Why I say that's surprising is, frankly, that rarely happens when a company's revenue jumps that their operating profit margin goes up. That rarely happens, first of all. When that happens, it means that while they're growing, their company is becoming more efficient and they're keeping their costs under control. And actually not just under control, they're maybe lowering their costs, or at very minimum, they're lowering their costs as a percentage of revenue, which leads to these increased profit margins. Increased profit margins are, again, as revenue rises, usually the opposite happens. Usually as revenue goes up, operating profits go down because companies have a problem keeping their costs under control. This is a fantastic sign that the management, A, knows what they're doing and they're executing well, but B, knows how to run a business properly, because, again, this is very rare to see that. They have bought back some shares. Again, very surprising for a small-ish company. They bought back shares. They had 14 million shares in 2011, and they have 12 million shares now in the trailing 12-month period. So they've bought back about 2 million shares. That's fantastic. Again, surprising, because most small-ish companies don't buy back shares at all, because they need that money. They need to actually issue shares. Most of the time, they dilute shareholders to because they need that capital to grow. Book value per share has gone up significantly because of the combination of operating profit and revenue increases combined with a lower share count. The book value per share has gone up from $4.61 in 2011 to $16.60 in the trailing 12-month period. This shows, or is a sign, that the underlying intrinsic value of the company is going up over time to a significant degree. We'll see if it actually is true when we get to the balance sheet for things like goodwill, intangible assets, stuff like that, that we'll talk about if they show that stuff. Wow, their ROICs are absurd, in a good way. They have gone up from 23.4% in 2011 to 87.5% in the trailing 12-month period. How absurd is that? Absurdly good is that. I look for anything above 10% on a consistent basis. So the ROICs at 87.5% are almost 9 times what I look for. That means, for what this means in a real world sense, ROICs measure profitability. What this means in a real world sense is the company, for every $1 in sales it has, it earns ROIC of 87.5 cents for every $1 it earns. And we'll illustrate that more fully when we get to free cash flow. But that reminds me that they showed up as having a negative forward PE, which I don't know why, because they are profitable at $150 million US in the PE. So that means, what was the forward PE? So maybe that means analysts or the company expect them to not be profitable going forward, which I don't know why. They've been profitable every year in the last decade. So that's interesting. We'll have to figure out what's going on there. But their ROICs being amazingly good, frankly, one of the better ones I've seen, probably top 10, 20 ROICs I've ever seen. That's fantastic. The free cash flow to sales is also fantastic. I look for anything about 5% on a consistent basis here. And they've been over that every single year for the last decade, and they're at 10.2% now. So that is fantastic as well. A good chunk of cash on the balance sheet, 54.2% cash and short-term investments on the balance sheet. Inventory is up. We need to figure that out. And we'll see that more with the cash conversion cycle, but their inventory is up while their accounts receivable are not up. That is not a great sign. Again, we'll kind of look at that when we get to the balance sheet and the cash conversion cycle, but that's something we need to watch for. According to this, they have no accounts payable, which I find harder to believe. They have no short-term debt, which is not hard to believe. So I'm assuming some of this data isn't being pulled in. We're going to have to go look at that. They also have no long-term debt, which, again, is not a super big surprise, but we want to make sure when we're looking at the balance sheet. Okay. So here's what first potential major issue with Medifast is. The cash conversion cycle has gone up from 19 days in 2012 to 34.1 days in 2020. Their trailing 12-month number is not showing up. Again, I don't know if these numbers are negative, if they're not populating properly on Morningstar. I don't know. But one thing we do want to see here is, or that we can see here, is that their days sales outstanding has been super low over a long period of time. That's not showing up. Again, we need to know why that's not showing up. Is it negative? Are they having issues selling stuff? What's going on there? Another thing, days inventory has fallen from 97.8 days in 2011 to 75 days in the trailing 12-month period. Sales, accounts receivable, trade receivables on the balance sheet, which we'll see in a second, and inventory should rise or fall at about the same rate. They are not. That can lead to huge potential issues, which again we'll cover more when we get to the balance sheet. But their overall rise in cash conversion cycle shows they're becoming less efficient over time, which frankly does not really show up in their margins, because their margins have been consistently pretty good to great, and they're actually improving. So that's a bit interesting. It's because their cash conversion cycle has fallen a little bit because they're paying their stuff faster by about 22 days, actually 21 days. So that is fine. The bigger issue here is we want to know what's going on with the inventory and the accounts receivable. We want to know what's going on with those. Oops. The quarterlies, and then we want to go to balance sheet. So this is $2.2 billion company. They have $191 million in cash, $192 million in cash rounded up, and short-term investments. Actually, $197.4 million in cash equivalents, and short-term investments. That is good. The inventories have skyrocketed in just the last year from 41.7 million to 95.8. That is not good generally. Let's go back and look at the annuals to see what's going, or to see the trend. So their inventories have skyrocketed from $18 million in 2016 to 91 in the trailing 12-month period. Or 95.8 in the trailing 12-month period, while their accounts receivable have not gone up. That is not a good thing. What that means, or it's one sign of meaning, is that they might be having issues selling their stuff because inventory is building up. When inventory builds up with a not similar increase in accounts receivable, that could mean the company may have to discount their stuff to sell it, because maybe they're producing stuff now that people aren't buying, or maybe it's gone out of style, or whatever. This is a problem in the health arena, is that stuff changes all the time. So maybe their stuff isn't selling or it's definitely not selling as well as it was. That could lead to having to discount products. If they have to do that, that lowers revenues, that lowers profits, that lowers cash flow. Or they may have to just completely write off inventory completely. If they have to do that, that lowers this value here, $95.8 million, which lowers the balance sheet. The value of the balance sheet will lowers the underlying intrinsic value of the company. It also could be, frankly, maybe with all the COVID constraints and the supply chain issues going on right now, maybe they're building up revenue, or maybe they're building up inventory, because you can see the pretty gradual increase in the last year for the holiday rush. I don't know at this stage, but that's something we would want to figure out in the annual reports and the quarterly reports, figuring out what's going on with their inventory, what's going on with their accounts receivable. Because they should rise or fall at about the same rate. They're not. Inventory is skyrocketing while accounts receivable are going down. So accounts receivable is typically future orders, stuff like that. So they're going down as inventory is going up. So that is not a good combination. Assets, very good. Again, I don't know if what's going on with their payables. They should have some payables here. Why should they have payables? Accounts payables or trade payables are things like paying for suppliers, paying to suppliers for things like supplements or manufacturing or whatever. I don't know if this is just zero here or if it's negative, if Morningstar's not pulling in some of this data, but again, that's something to figure out as well. Minimum amount of debt, $5 million in short-term debt and capital leases. Same thing with long-term debt and capital leases, $16 million rounded up. Their balance sheet is very clean, other than the inventory and accounts receivable and accounts payable issues. That's something we want to figure out. But as of right now, this company looks like a potentially good investment. We will see where that shows in the valuation, because that's where most companies go to die for me. Interestingly enough, Medifast is not insanely overvalued. We'll get to why in a second. First, I don't care much for PE, price to cash flow, or forward PE. When I do, I want these to be under 20. PE is at 14.9. Price to cash flow is at 15.2, and forward PE is not showing. Again, I don't know why. Maybe that means the company and or the analysts expect them to not be profitable in the future. If so, I would want to know why, because again, they haven't been unprofitable on a net income or operating income basis for the last decade. So fast stock news. So again, the process you're seeing here is the process I would go through when doing this. And that's a quarterly dividend. Not seeing anything in recent news going back to about June that would cause these issues. Let's go one more. Okay, I'm not seeing any issues. Medifast stock issue. Stock. Let's go with problems instead. Surpassed estimates. This might be what's going on. No, let's say maybe they're a meme stock. They're not. They're just showing up on the thing. Again, that one thing was going back to 2019. I'm still not seeing anything. Boom. Yeah, I'm not seeing anything in a negative for them. So again, some confusing stuff. Might be just Morningstar not pulling in the data. Not sure. But the most important number down here is the enterprise value to EBIT. It's at 10.33. I look for anything below 8 to consider the company undervalued. So what this shows me is that Medifast is about fairly valued right now, but they have a potential major issue with their inventory levels and their cash conversion cycle and all the stuff we talked about. Their margins are fantastic and rising. Their profits are fantastic and rising. The inventory issue, though, is a potentially major. When I say major, as in potentially investment threatening. Again, if they have to write down the value of the inventory, or their stuff's not selling as well, or they're having issues, those are, or they have to discount their products because they're not selling as fast. Those are potentially massive issues. Again, it could be as simple as maybe they're just building inventory for the holiday season. I don't know, but at this stage, it's fairly valued. And let's see here. What do I want to do here? This one's confusing. This one, oops. Let's bring my face back. I tried to bring my face back. Press the wrong button. This one's a bit confusing. So what we're going to do here is we're going to take this to the second stage of my analysis. Usually when stuff's kind of on the fence for me, most of the time I just kind of toss it because it should be a quote-unquote screaming buy according to Warren Buffett's terminology that I pretty much live by. This one is interesting. Mainly, I want to do this. I want to keep going on this because I want to figure out what that issue is with the inventory, or if it's an issue at all, because that frankly affects the entire thought process analysis of this company. So I want to figure that out. Before we get to that, though, we're doing a second stage video on this, or second stage analysis video on this, where we do the actual full preliminary analysis worksheet, which I'll tell you how to get for free at the end of this video. But interesting case study. Ocean, as always, very good case study. You always find interesting stocks to look at. This one is another one, so thank you for that. If I missed anything, if I should explain something better, if I didn't explain something well enough, if I missed something completely, let me know in the comments below. If you're watching on YouTube, thanks so much. Really appreciate it. And make sure to like, love, comment, subscribe, all that good stuff. And if you do subscribe, make sure to hit the notification bell so you're notified every time I release a new video, and release new videos all the time. If you are notified, or if you get the notifications turned on for our channel, you'll also be notified every time we do a live as well. And we do lives at least once a week on YouTube and Facebook. If you're listening on the podcast, again, much appreciated. Thanks so much. We'd also appreciate all that same stuff, but on the podcast, we'd also appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you want me to look at a stock like this for you, let me know in the comments below, and I'll look at a stock anywhere in the world for you for free, if it meets 3 criteria. I feel like I'm saying if a lot, but that's what it is. If it's not a bank, because I don't know how to evaluate banks. If it's not an insurance company, because you have to dig into the actual annual reports to evaluate them. And if it produces revenue, I'll look at, or it has to be producing revenue for me to evaluate it. Why does it have to be producing revenue? Because I evaluated some stocks for some viewers a few months ago, and it wasn't producing revenue. And because at this stage, I don't care about what the company says they're going to do, about their growth plans to take over the world. I don't care any of that right now. The stock analysis videos are pretty boring. So if it meets those certain criteria, let me know, and I'll look at a stock for you anywhere in the world. I am now giving preference to masterclass students, or to students of our masterclass, but I don't see any of those on the calendar right now. So if you want me to look at a stock and it meets those 3 criteria, again, anywhere in the world, I'll add it to the calendar. If you want more help from me, or if you want more help on how to become a better investor faster, make sure to check out our 5 free gifts, which you can get for free at the links below, which includes the full preliminary analysis template and worksheet that I was talking about a little bit ago, that we'll see in video number 2 on Medifast. You can get that for free so you can analyze stocks better and faster. You can also get a free PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks 3 Times You Must Sell. You can get all 3 of those at the links for free below. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our newly relaunched masterclass. We're already getting students in. We're already starting the live trainings, the live group trainings, and the live group stock analysis. We're doing those. You'll also have the chance right now, as of this recording, for the first 10 people to sign up to get $9,000 worth of bonuses for free, including live one-on-one trainings with me, and all the other bonuses that come with the masterclass, and what we're calling our value investing blueprint, which is my exact process, step by step, on how to find value and evaluate stocks better and faster. This process allowed me to evaluate 3,943 stocks in 40 days during the COVID crash last year. It's also a huge reason of my me far beating the market in the last 9 years as well. You can get this for free by joining the masterclass today. Again, there's only certain spots, at 10 spots as of this left, or actually 8 spots left as of this recording to get those free bonuses. But you can do that. You find out information about the masterclass and and how to get these free bonuses at the links below. But until next time, have a great day. Talk soon. Bye.